I know I need a different approach to investing, and I feel Intelligent Invest will buy stocks that I won't buy myself, and also I think they'll probably make bluntly gutsier decisions than I will.
Hello, I'm Tony Kaye, I'm the editor of Eureka Report, and I'm joined today by Callam Pickering, our economics writer. Hi Callam, thanks for coming in.
Good morning.
Today I wanted to talk about interest rates, what's happening. We saw the US Fed increase rates over there last week and has indicated rates will keep going up. So what's actually going on over here?
Well, it's actually quite interesting. Normally, when I look at a Federal Reserve rate hike, I would talk about how that's going to affect the Australian dollar. Normally, it would make the Aussie dollar a little bit weaker than it otherwise would be. But what was very interesting about the meeting last week was that it actually went the other way. The dollar actually got a little bit stronger because the Federal Reserve, despite raising interest rates, was actually a little bit more dovish than the market was anticipating. So there was a bit of repricing there that actually pushed the Australian dollar higher than it was. Now, if we look sort of at what we expect over the next 12 months, with the Federal Reserve expected to raise rates another 2 times, I'd naturally expect the Australian dollar to react to that in a negative fashion. That is, it would depreciate down to a much lower level. I think in terms of the effect on the Australian economy, one of the first things we saw was that both NAB and Westpac reacted by raising mortgage rates on owner-occupiers and also investors, which was in response to the higher funding costs they have, because now when they borrow from the US, they're being charged a higher interest rate.
Yeah, they certainly didn't waste any time, did they? They jumped straight in there to move outside of the cycle here.
Yeah, they certainly reacted more quickly than I had anticipated. I thought they might wait a week or two before making the move, but NAB actually reacted the day of the meeting. And Westpac reacted on Friday.
And I suppose we're going to see other lenders follow through pretty much, which is the normal course of events.
Yeah, I'd be surprised if the other 2 major banks and some of the minor lenders didn't follow suit this week. If not this week, then certainly next week.
And this is the thing really, that Australian rates are still at record lows. They haven't moved for quite a while now, but more lenders are moving out of the cycle. And we're also seeing that lenders are tightening up their criteria specifically for finance, for investment finance, by increasing the servicing assessment criteria.
So there's a lot of different dynamics at play here. Firstly, banks are reacting to higher capital requirements. So APRA wants them to hold more capital against their mortgage assets, and they're passing on the cost of that to households via higher mortgage and investor interest rates. We're also seeing there's increasing concern regarding the investor segment of the market. It's been running hot for a number of years now, and it's actually picked up significantly over the past 6 to 12 months, to a degree that I don't think APRA had initially anticipated. So the market expects that APRA is going to come down hard on the investor segment. I think to some extent they're preempting that by increasing the lending terms and conditions, by increasing the servicing requirements on those loans, in order to hopefully stop APRA from going ahead and putting forth more stricter measures.
And do you think that, all these measures seem to be starting to have an effect in terms of cooling off the market? Do you think that's going to happen?
Well, in the past we have seen that some of the measures introduced by APRA, the 10% investor lending limit, for example, did work to some extent. The problem was that it sort of bounced back eventually. So the banks took it very seriously to begin with, and then they sort of wavered on it, and the lending in the investor segment came roaring back, as it has. I think APRA, if they want to be successful with regards to these measures, probably have to be a little bit stricter with what they're requiring. So they might introduce, say, a 5% credit limit on the investor segment that would force the banks to draw back on what they've been doing with regards to investor lending. Only time will tell, though, whether these measures can be successful long-term in controlling the housing market.
And we're seeing most weekends still that auction clearance rates are above 80%. So it's not as if there's a dramatic impact at this stage, but I guess as criteria get tightened up, as lenders move outside of the lending cycle or the rate cycle, we're going to see probably more impact over time.
I'd expect that to be the case, yes. Auction markets should be the first place where we see the effect of these measures, because we do get data on a weekly basis, whereas for lending data or house price data, we're only getting information on a monthly or quarterly basis. So if we do see that auction clearance rates do decline from the 80% level down to the 70 or the 60% level, then we'll know that some of these measures, some of the existing measures, but also some of the measures likely to be introduced, are actually having a significant effect on the market.
Oh, thanks, Callam, for coming in again today.
Yeah, thanks for having me.
Thanks again for joining us for the Economic View. We'll see you again next time.